Welcome to the weekly update, where I'll go over the action in the market for June 6th through June 9th, and then we'll see how things are looking for the upcoming week of June 12th through the 16th. Now, some of you who've watched these videos before, I probably sound different. The screen may look a little bit different. I had a computer problem a few days ago. I have a really good computer, but it has a problem with its power unit, and that's gone out for about the fourth time now. And until I can get that up and going again, I have to go back to the other way, or my backup way of recording the videos, where I use Zoom and just record the screen that way. This will all be take one. So you're going to get my fumbled words. You're going to get me if I clear my throat. You're going to get me as I repeat things that I didn't say quite the right way. The video might also be a little bit longer. I'm kind of interested to find out, especially for those of you that have been watching these videos for a bit. Do you think it's that big of a difference? Because it takes me 2, 3, 4, 5 hours to edit a video after I record it. This way, I just record it and upload it and I'm done. Is it that big of a difference? If there's not, I just soon keep doing the videos this way and upload them. That frees me up to do a lot of other things, where like doing research, finding new charts to look at, new ways to analyze the market, because that's what I really like to do. Or do you think having a little bit better polished videos really makes that big of a difference? Anyway, I'd be interested to hear of your feedback. So before I get into the charts and what happened this past week, I am using a backup computer right now, so things might be a little different than what you're used to. I also have a different microphone, a whole different way that I do things. I have a new supplemental video that I posted about a week ago. If you only watch the daily if you only watch the weekly videos, you haven't heard about this yet. I posted a supplemental video about a month and a half ago. This is a new one where I go through and talk about hedging, or how you can protect yourself in the market. So please feel free to check that out. There is a PDF of all the slides and charts that you can access by going to the description below the video. And that's both for YouTube and for Rumble. I do have a private Facebook group. You're welcome to come check that out, see if it interests you. I also have a new poll that I'll be posting after I get done with this video. And I also post on Rumble. As I explained before, a few weeks back, YouTube took my channel down. They took my channel down, saying that I violated some kind of whatever it was. It's probably some robot that came through, saw something it didn't like, took me down. About 3 hours later, it was all back up. They said everything was fine. But we never know when that kind of a thing is going to happen. So if you try to find me on YouTube and I'm not there, go over to Rumble. I guess the same thing could be said. If you don't find me on Rumble, go over to YouTube and see if you can find me there. That's why I like to post in multiple places. All right, let's do away with all this other stuff and now talk about what happened. To go over the highlights of the week, we were up 1.39%, but volume was below average. We're really dealing with some things in the market right now, and I'll explain that as I go through. We have some major overhead resistance at 4,300. We also have the August high. In Friday's session, we got just about up to the August high, above 4,300, but then we fell back after that. We're really overbought in the short term right now. And so it looks like maybe the market doesn't have quite enough gas to really shoot higher. Things are positive overall, but as the market's trying to figure this out right now, we have dropped to below average volume. The technicals are pretty much positive on the daily charts and on the weekly charts. We're overextended on the daily charts, especially in the short term and somewhat in the intermediate term. The debt ceiling issue is done now, so now we're flopping back to being fixated on inflation and interest rates. The market's always fixated on something. That's why I have a whole list here. Our trend is getting stronger. Now, we're not above 20 on the weekly chart, but it has crossed back above its moving average, so that means we're going up, and the green line is also on top, so that means that we are positive, and I'll show you the chart. For the week, the Dow was down 0.3%. The NASDAQ was only up 0.1%. It had been really doing quite well. Took a bit of a week off this last week. The S&P was up 0.4%. And then the small caps, which had really been underperforming, man, they were up a week ago Friday strong. They were really down on Monday. But then Tuesday and Wednesday, the small caps and the mid caps really saw some strength. And that's what we need if we're going to shift things back more positive. So going over the highlights of the week, on Thursday, the S&P, it did close more than 20% above the October low that we set in October 2022. This meets the technical definition of being in a new bull market. Now, we could decline from here and get out of that, but that's the way things stand right now. On Friday, we were able to get above 4,300 with the S&P. We almost got up to that August 2022 high, but we couldn't hold on to those gains. We ended up drifting lower, closing below 4,300 on Friday. The S&P was up for the fourth week in a row. Hasn't been real gangbuster. We've been doing a lot of chopping sideways as this whole thing is being worked out, but we have been chopping sideways and going higher at points. There's still this real hope for the soft landing. You'll see that. I talk about that in the daily videos. I'll also be hitting that topic in the intermarket analysis video. Small caps were up 1.9% on the week, so they really did well. And then Goldman Sachs came out and they lowered their probability of us hitting a recession in the next 12 months. They had predicted we have a 35% chance of being in a recession. Well, now that's dropped to 25%. And the reason they're saying that is because of the banking situation that we've been working through. A little bit of old news, not necessarily all that relevant, but the market still pays attention to these things when people like, or outfits like Goldman Sachs says something. Interest rates were up on the week and the dollar declined as well. And then the Bank of Canada just came out and surprised all of Canada with a 25 basis point hike at their meeting this past week. That raises their rate to 4.75%. Just to quickly go over each day on Monday, the S&P closed lower. If you remember the previous Friday, right before we had that really nice run up. And then the Monday, we kind of slowed down a little bit. And so the S&P ended up drifting lower on that day. On Tuesday, this is when the Russell 2000, the small caps, and even the mid caps really started to show some strength. The S&P did have a late day rebound, and that's always positive because that's the smart money coming in, and they tend to wait sometimes to do what they're going to do, and that helped shift things more positive. Then you had this thing about Coinbase, where they were charged by the SEC as being an unregistered securities exchange, as well as not being a registered broker or being a registered clearing agency. There's the back and forth about all of that. There is this idea that the government wants to regulate everything, but if you know much about stock market history, you might want the stock market to be one of those things that is overseen by an outside agency, and that has allowed the U.S. economy and the U.S. stock market in particular to become the strongest market in the world, because the little guys like us, we play on the same playing field that the big boys do, where it used to not be like that. So, but on the other hand, if you are more of a hands-off type of person and you don't want the government messing around in anywhere in your life, then you don't like that. And that's what goes back and forth as they're trying to figure out what in the world are they going to do concerning cryptocurrencies. On Wednesday, the small caps were up again. They had another 1.8% gain, and this started to show some broader strength in the market. We had been seeing the big boys, 8 to 10 stocks, some counted as 7, depends on what you pick. They were really keeping the market going higher. Well, we started to see more of a participation on Wednesday. We also saw that kind of tail off again on Thursday, where the mega caps came back in and took the lead. And we saw kind of that same thing on Friday, where the S&P did gap higher at the open, but it just couldn't hold on to its gains. And then the mega caps, and I spelled that wrong, or mega CPAs if you're an accountant, they maintained the lead as the broader market started to underperform. We want to watch the broader market. We focus on the S&P, but we're influenced by all the other markets out there, because when other markets are happy, that helps to make the S&P happy. And the inverse of that is also true. All right, the poll results from a week ago. The first question, we are seeing lots of negative divergences in the market as it has been moving higher. Do you think? that the broad market will strengthen. 20% said yes, 80% said no. This will show some weakness. Dropping down to the lower left, and I don't have the laser pointer. I only have my regular mouse pointer here. In the daily videos, so some of you don't watch those that see this video, two charts that compare the current market right now with 2011, and I've been talking about that, and I did hit that in the weekly videos also. This was when the last major debt ceiling crisis was an issue. Now, at the time I posted this, the debt deal hadn't been finalized. The charts show that we really got into a bad downtrend in late July and into early August. Do you think something like that will happen this time? Everybody said yes. So we'll have to see how that goes. Then, do you think that the Fed will raise rates at their next meeting? 83% say yes. No, I'm sorry. 83% say they'll keep the rates the same, where 17% say that they will raise them. And then on June 2nd, we had a really strong day as well as a good week. What do you think this next week now that we just finished will be like? The market will go up 13%. The market will pull back and then go higher 13%. The market will reverse and go negative. That really didn't happen. And we'll end up going sideways. That's kind of what happened, more or less. We did break through. We got up to that 4,300 level a few times. Friday was the only day we were actually above it. Looking at some Isabel Net blog charts, this is the weekly chart that we look at of insider transactions, and these are legal insider transactions as opposed to the illegal kind. And we're starting to see a lot of action here. This is suggesting that some weakness may come into the market when we look at this chart. A lot of people have been doing a lot of insider transactions. Then we look at the extreme concentration risk where it remains. These, I don't know if this is 5. Okay, they've actually dropped it down to 5 now. There's 5, 7, the great 8, 10 company, whatever you want to do. But these are the weight that they carry as far as worth in the S&P 500. And then they also influence what the S&P 500 does and how that's really been going up. Then we look at flows into or out of tech stocks, and we're actually seeing people getting out of tech. They thought, okay, we've run up. We had a good run right here. It's not going to go any higher. I think I will go ahead and sell, and we're seeing money coming out of tech. Then the ISM index, which was a report that came out about a week ago now, that's the dark blue line. That's the manufacturing index, and it continues to fall. But then we measure the spread between high yield, which means junk bonds, and investment grade bonds, which means higher quality, lower yield. This keeps going up, the light blue line, where the dark blue line is going down, where these have a tendency to go in the same direction and not get all that far apart from each other, at least on this chart. What's going to give? Are we going to see the spread come down, or are we going to see the ISM manufacturing index go up to make this more equal? Then I usually don't show this, but there's been a lot of talk about this. In 2022, for the S&P 500, the earnings were at $220 per share. All right, when you take all of the S&P together, the estimate is that it's dropped to $195 per share. Then the estimate later on, and the consensus is that it'll be $221. So there's a little bit of discrepancy between Morgan Stanley and the consensus. And then looking out into 2024, where Morgan Stanley, they think we'll be at 241, where the consensus estimate is 246. This is kind of keeping the market going for right now, is that, okay, earnings are going down, but they're going to get good again in the future. That's kind of the scenario that's playing things out right now, and that's helping to keep the market from really tanking, and sometimes lately even to go up higher, because that's ultimately what drives stock prices. Then looking at the cumulative fund flows across the different assets, we still have most money going into money market funds, which is not a surprise. They're giving a lot better return. So people are taking their money out of their savings account and putting it into a money market account. Then in second place are government bonds. They're seen as a lot less risky. In third place are equities, which means stocks. And then in last place, which is kind of the, I don't know, redheaded stepchild of the market, even though it's blue here, corporate bonds. People don't realize that that's a huge market in and of itself, but we don't necessarily pay attention to that one as much, and it doesn't see as much inflow. FactSet came out with just one blog post this last week. They're asking, what is driving the expected rebound in the S&P 500 earnings growth when we look out to the fourth quarter of this year? Well, here's the chart, and this is where we're at right now. That's why I put a red box around this. And with the earnings reports that have been coming out, we're seeing a 2% decline. And then in the quarter that's going to end at the end of June, we're seeing an overall 6.4% decline. But then going forward, well, look at it. We're turning positive again. If you look out even further, we're getting really positive again. This is helping to keep the market up right now. Are these realistic? Are these just fantasy? We don't know yet. And these are constantly adjusted. So we'll have to see how things go forward from here. Then looking at the top contributors of the S&P 500 in the earnings growth, this is 4. We dropped it down to 4 now with Meta. See this dark blue column here? NVIDIA, Alphabet, which is Google, and then Amazon. These are the companies that are really holding things together right now. Current market valuation, they updated in enough time before I started recording. We're starting to tip over when we take all of these charts together into the overvalued category. And it could go higher than this when I look at the historical chart. We're just above the 1 standard deviation now, meaning that we're overvalued. But see in the past how we could go all the way up to the 2nd standard deviation. Doesn't mean we have to stop here. It just means that we're going up pretty far, pretty fast. And at some point, to see a pullback would not be a surprise. Now, breaking down the different models, looking at the market valuation, the Buffett indicator, which compares stock price to GDP, we're above the 1 standard deviation. So that is considered overvalued. When we look at the PE model, that's also above the 100 standard deviation, so overvalued. Interest rate model, because rates are low still historically. I know it doesn't seem like that. And we have a lot of these inverted yield curves, and we're still above the historic trend line, and we've not reached the 1 standard deviation yet. Then when we look at the mean reversion model, this is the price of the S&P 500 and how far is it getting away from its historic trend line. It's getting a little far away now. It could go farther than that, but we're seeing that at some point an equilibrium will need to take place. The recession indicator models, because of the inverted yield curves, it's suggesting that we have a very high likelihood of going into a recession. If you just look at that. Then we look at the state coincidence model. We're not seeing a real rise in this chart overall. The higher this goes, the more chance that we are actually in a recession, and that's just low right now. Then we look at the margin debt, which was updated at the end of April. It's still below average overall. People aren't borrowing money from their broker to go in and buy stocks. When we get really optimistic with that, sometimes that can mean a longer-term top in the market. Then the junk bond spread model is also neutral right now, not giving us an extreme reading. Getting into our charts. First, we look at an intraday chart where we start back on Monday, the 5th, where it looked like, okay, here was Friday. This was that strong day up we had, and then it carried over into Monday, got about halfway through the day, came up to this 4,300 level, and then started going down. We gapped lower, went back up on Tuesday. We got back up to the 4,300 level, just a little bit below that on Wednesday, and then fell back. On Thursday, clawed our way back overall. Then on Friday, we gapped higher above 4,300, went up to just about the high set back in August, and then spent the rest of the day coming back down. For the week, small caps did the best, and this just takes the 5 trading days, Monday through Friday. It's not Friday to Friday with these charts. And the mid caps also did quite well, and that's encouraging. If we want to see some broader strength in the market, we need to see these guys really kick into gear, as well as the NYSE. The S&P did underperform these other indexes, but these other indexes give support to the S&P, and the NASDAQ 100, which has been doing really well, it was down over the last 5 trading days. When we go back to the beginning of the year, the NASDAQ 100 is in first place, followed by the NASDAQ and then the S&P, and all of the indexes now have switched back to being positive for the year. Then if we go back to the all-time high, all of the indexes continue to be negative, and it will be until we get back to that all-time high, whenever that will be. Looking at the different sectors, discretionary did better. This is another area we want to watch. This is more of the growth area. And if we want to really see some strength in the index, discretionary has to do better. Utilities, which have been showing us a negative divergence when we look at the Dow, the transports, and the utilities, they had a pretty good week. Energy, which was great in 2022, has really been under a lot of pressure in 2023. Look at the bottom, the areas that have really been doing well, tech and Staples continues to show weakness. That's more of a value area. But there was some profit taking in tech this past week. Then I have two charts to show you with our relative rotation graph. And if you want to know the symbols, they're over here on the right-hand side. This is the chart that I usually show, and it's based against the SPY, which is the ETF for the S&P 500. This is the weekly performance, and it goes back 1 year, showing that communication and tech have been doing the best, even though they're rolling over a little bit. The Y is discretionary, and that's starting to show some improvement, where the other areas, they're turning up, but they have been showing a lot of weakness. We've been seeing a lot of this market led by just a few stocks that are mainly communication and tech stocks. We need to see these other stocks continue to improve if we're going to turn back more positive. Then this is the new one where I use the S&P 500 itself as the benchmark, and I say, how have things done over the last 3 months? Where we have XLK, which is tech, was leading, but showing some weakness, followed by communication, where we see discretionary doing a little bit better. And then these other areas that on the previous chart were still red, now they're starting to turn blue. So we are seeing longer term, some more strength coming back into the market, which could be positive. Then when we look at the sectors for the week, the energy sector, which had been really beaten down, was first, followed by discretionary. And then the tech, communication, healthcare, and staples were negative for the 5 trading days. When we go back to the beginning of the year, tech, communication, and discretionary are doing the best. And then a lot of the other sectors still remain underwater. Going back to the all-time high, energy is the only one still showing a gain, and even it's been giving back a lot of those, where all of the other sectors still remain negative. Looking at sentiment, this is where we're tipping into that extreme greed area. But then when I show you the historical chart, we could go higher than this, but it just means that we're going up. We're getting a little too positive about things. When we get above 75, we look at using this as a contrary indicator. When it's going up, we can go with that. When it's going down, we can go with that. When it gives us extreme positive or negative readings, that's when we're looking to do the opposite, when our other chart suggests that may be wise. This is also a new chart. Even though I go over this every week, this is now being included with stockcharts.com. We have a weekly chart of the S&P on top, and then this is the active asset managers. I used to have to go to their website to get their information. Now I can just use a chart. They're starting to get pretty extreme. Now we could go higher than this. This is just an arbitrary level that I put on here. But when we get above this level, we could also be looking a little toppy. The Radix bear bull ratio, not extreme pessimistic, not extreme optimistic right now. We're just about at the midpoint. The Ulcer index, and we're seeing a real drop off on the daily chart too, where we're going down over here. And then this is actually counterintuitive. When this line's going down, that means tech is going up. We're comparing 1 to 3 month T-bills, which you could say is cash. And we're comparing that with what's the tech sector doing, and we're then plotting that on a weekly chart. This is an Ichimoku cloud to help us see support and resistance levels. When this ratio is going down, that's good for techs. Well, beginning of 2022, it started to go up, and techs were under a lot of pressure. We still continue to see this ratio going down overall, so that is more positive. And we look at the VIX, which is getting low, very low, but it could still go lower than it is now. The line chart is dropping down, and we actually can see the red line again. That's at 12.5. That's just a static number. We'd also like to follow the overall trends of the VIX, and the bar chart is also continuing to drop. Then we look at the weekly reading from the active. Sorry, let me back up. The weekly reading from the individual investors. they're getting pretty optimistic right now, but they're not extremely optimistic. Remember, these folks, of which you and I are one of them, we tend to react to what's already happened and then jump in, and a lot of times we're late to the party. So when we have an up week, they get more positive. When we have a down week, they're more negative. I also follow this red line more to see what's the overall trend of how they're feeling. Looking at the economy, this is the GDP Nowcast showing that we're at the top of the range when you ask people, economists, what do they think is going to happen. We're at about 2% to the upside, and we're at about maybe down 0.5% to the downside. The green line is, I'll show you on the next chart, this is the estimate based on what the Atlanta Fed does. That is this chart right here, and we're still seeing positive GDP looking out from here. And then this is also a newer chart where I had to go get the information somewhere else. This shows the spread between the risky bonds and the not as risky bonds. When this is really going up, that means we're really kind of nervous. Well, this ratio is continuing to go down. Then we look at the Chicago National Financial Conditions Index. We only get nervous about this when it goes above the black line and we're still below it. Then we look at the tightening standards for banks. This hasn't been updated since May 8th, and it still shows that banks are getting a lot more stingy with who they lend money to. This also has not been updated since June 2nd. We only get excited with the real-time SOM rule when we go above the red line. We're not even above the black line. And then the smooth recession probabilities index, again, when we're above the black line and then get up to the red line, that's when we're nervous. We're far away from that now. But this information is lagging, so we might not know this until after it's already happened. The Brave Butters Kelly leading index. Also, this is a little bit of a concern. It hasn't been updated since the end of May, but the fact that we're going above this black line is a bit concerning. Looking at inflation, this is the Inflation Nowcast, where it shows the CPI inflation, and we're going to be getting that report this week, and the PCE inflation, and then how it changes on a daily basis going back to the beginning of the quarter. It's pretty much stayed flat. We're seeing a little bit of an increase with the PCE core going up because a week ago we had the PCE report that came out, and they usually adjust after that comes out. Keeping an eye on the Fed, just to tell you a bit of a story. If you go back to Friday, May 19th, there was an 82.6% chance that the Fed was going to leave rates where they're at right now. A week later, on the 26th, that dropped to 35.8%. Then a week after that, we went back up to 74.7%. That was as of June 2nd. Can you see that the market's a little bipolar here and they're fixated on things all the time? This is where we're at right now. We dropped down a little bit, but there's still a 71.2% chance that the Fed is not going to raise interest rates. To show you this a little different way, this is after Friday. The blue column, that's where we're at right now. We compare it with a day ago, a week ago, and a month ago. And the odds of the Fed keeping the rates the same has gone down a little bit, where if you look over on the right, the odds that they may raise rates 25 basis points has also been going up a little bit. We still have Monday, Tuesday, and they'll make their announcement on Wednesday, so we'll see how that goes. Then looking at the Fed balance sheet, it is continuing to drop overall. Then we look at it on a change basis. Where was it based on where it was a year ago? It also is continuing to decline. Now, getting into our charts, breadth based on price, it's a little hard to see, but we're above the moving average and we're showing some improvement based on volume. We're also seeing some volume improvement with the daily charts, and that's always encouraging. Then looking at the new highs, new lows, this is a little discouraging. We're not really breaking out. We're doing okay, and our 4-week is turning back up, and our 10-week is turning back up. We're turning up on the daily charts too. But until we can get above 4,300, close above that level, and then get above the August high, it's going to be really difficult for stocks to show a lot of improvement based on this chart. Accumulation distribution above an advancing moving average. That's positive. It's also positive on the daily charts. The advanced decline ratio still above 0, even though it declined a little bit. This is positive. Looking at our trend, this is where the ADX is turning up and it's above its moving average. That's the good news. The bad news is we're still below 20. Switching back to the good news, the green line is on top and advancing. If you're more aggressive, you like that we crossed here, but at the same time, be aware of the overhead resistance that the market has to deal with. That's kind of the real story right now. With the Arun indicator, we're getting a little extreme positive, and we're seeing a confirmation of that on the daily charts, where when this oscillator gets pegged near the top, now it can stay up here for quite a while, but sometimes this will mark a top in the market. The mass index is not generating a signal right now. Then looking at some other charts, here's a daily chart of the S&P. We came almost back up to the August high. I know I've got lots of crazy lines on here. When I look at other people's charts, the more lines they have on the chart, the more I'm willing to just rip that up and go on to the next one, especially when they draw their own arrow lines. I think that's just a kick. And it's always down if you're an Elliott Wave person. Now, if you're into Elliott Wave, hey, go for it. It's just they tend to be a pretty pessimistic crowd as a general rule, but that's why I use a lot of different charts and I try not to put as many lines on them. But these are based on price, not fairy tales looking forward, where we did get above 4,300. Now, if you look at this bar for Friday, it's a little bit concerning where we saw the strength early in the day and came down. And even though we were up, we closed lower than the open on Friday. Is that going to signal some kind of a reversal? We don't know for right now, but sometimes reversals happen that way. Then the pivot points were above the monthly pivot, so that's positive. And then we're above the 50-period simple moving average. That goes back 50 weeks. That's positive. And our long-term trend continues to be positive. The McClellan oscillator ticked down just a little bit, but we're above zero. That's positive. The summation index based on price is crossed back above zero. And here's where we're seeing a little bit more strength with volume. That is going up a little better. Swollen trading oscillator above zero based on price and volume and advancing. That's positive. PMO oscillators going up. We're crossing back above zero based on price, and we've already crossed above zero based on volume. And we're seeing almost this exact same thing on the daily chart. The percent of PMOs that are rising, these are all the PMOs inside the S&P 500. We're just about at this upper extreme level, and we tick down just a little bit. The same thing we saw on the daily chart. We're also showing improvement with the buy signals, and we're turning up with the PMOs that are above zero. So this is more positive. The Bollinger Bands, we did go extreme positive on the daily chart, and we've now come back down. We're also not extreme right now with this indicator. Almost seeing the exact same thing on the daily chart with the bullish percent index. We're above 50 and advancing, but see how we're not really making a series of higher highs as the S&P has been going higher. If we break above 4,300, we want to see this really start to shoot up to confirm what's happening. This suggests broader participation. Looking at our oscillators, we're pretty much positive still across the board, and we're positive on the daily charts too when you go from top to bottom. Chaikin money flow continues to be positive. Chaikin oscillator also positive and starting to look a little extreme. The force index is positive. Money flow positive. Rate of change going back 1 week, we were barely up on the week, but that was still positive. Going back 50 weeks, we started to get a little extreme here, and we actually ticked down slightly. And then the RSI 14-week reading is still looking positive. We're above 50 and advancing. The special K, we're potentially seeing on the daily chart the black line crossing back above the red line since it crossed below in early 2022. We're saying longer term here where we're still positive, but now we're starting to cross below the red line on the weekly chart. This could produce a real contradiction if we're going positive on the daily chart and switching over to negative on the weekly chart. Just something we need to keep an eye on. The Stochk RSI in the weekly chart is still extreme positive, as is the Williams percent R. The ultimate oscillator is also starting to look extreme. The Vortex has the green line on top and advancing. That's positive. The Copic curve, we're seeing a signal generated on the daily chart, now also on the weekly chart. When we look at the weekly chart here, we're above all of these moving averages and fib retracement levels, and then the really long-term moving average. So we're holding up okay there. Our different charts, we're getting above the midpoint of the upper of this trend channel going back to 2009. Don't you love these mistakes? Heiken Ashi is still looking positive. The Kegi is looking positive. The Renko is looking positive. And the 3-line break is looking positive. The ease of movement going back 14 periods also showing some improvement. The equi-volume chart has a lot of green bars in here, so that's showing improvement. We added an X on the daily chart. We haven't added anything here on the point and figure chart with the weekly version. We're working off of a double top breakout on the daily chart. Here we're working off of a triple top breakout that was generated on the 15th of May. So these are confirming that based on this chart, things are still positive. Our different trading systems, the Elder Impulse system for the S&P weekly chart is still positive, and the dots are still underneath with the parabolic SAR, that we're seeing that confirmed on the daily chart. When we go back to the Elder Impulse system, we switch back to neutral after Friday. Looking at the broad market, here's the S&P on top, the mid caps, which are still pretty much going sideways after seeing some weakness. And we saw a real nice move up with both the small caps and the mid caps on Tuesday and Wednesday of this past week. The Dow is still in an uptrend, but really chopping sideways. The NASDAQ is what's really showing the strength right now, as is the NASDAQ 100. The mid caps, we're just seeing a death cross here. We're also seeing a recent death cross on the daily charts, and we're just getting ready to have a golden cross on the daily chart as well, where this is showing us a death cross on the weekly chart. A little bit of contradiction. Small caps, recent death cross, turning more positive on the daily charts, not coming through to the weekly charts at least yet. NYSE going down overall, but still in an uptrend. The Wilshire is looking more positive and in an uptrend. All stocks continue to look good. The biggest software companies in an uptrend. FANG has been doing well. ARK has been lagging behind. If we stay above this red line long enough, we might actually see a golden cross, but it's not there yet. The banks, after really just getting hammered, showed a little bit of a bounce this past week on the weekly chart. We were pretty extreme with the RSI. We're coming up out of that. The MACD is also trying to turn back up. Then the deposits, after really dropping off, we're seeing a little bit of an uptick in deposits again going into banks. Then looking at the Dow, this is more pronounced on the daily chart, where the Dow and the transports are showing more of a negative divergence. We're seeing a little bit more weakness in the utilities. It's not as blatant on the weekly chart. The broad market, CRB index, which is what we use to keep an eye on inflation, that continues to be in a downtrend. Oil has also been going a bit lower, down around 70. Copper still in an uptrend, bouncing all over the place, but has been seeing some weakness. The dollar, which was trying to bounce up, it was down on the week. Gold continues to be in an uptrend, as does silver. Then looking at bonds, the total bond ETF is still in an overall uptrend. Here's the daily chart of the yields, where we've been chopping all around as we're still inverted. Stocks continue to outperform bonds overall on the monthly chart. And then looking internationally with the US, UK, and German rates, not really changing all that much this past week. The red line is Japan, which we're keeping an eye on, and is its own little story. And when it's more applicable to what's going on, if we get into that problem, I'll share more of that. Then looking at the MOVE index, which measures the volatility of bonds, dropping off just a little bit as the VIX has been going down. If you look at the bottom, they're correlated really strongly to each other. And then looking at the 1 month yield and then subtracting the 3 month yield after going crazy, looking like an EKG, seeing something very surprising, we're getting back to more of a normal reading now. Relative studies. Here's the intermarket analysis chart going back to the beginning of 2022. Oil is still up overall, but it's down on the year, followed by the dollar and gold, where going back to the all-time high, bonds and stocks are still negative. The NASDAQ 100 ticked down just a little bit to the S&P, but it's still outperforming. The S&P 100 continues to outperform the S&P 500. Gold is outperforming the S&P, even though it pulled back recently. And growth, we're getting really close to a longer-term golden cross with this ratio, but we're not quite there yet. Bonds continue to underperform stocks. Gold came right up to this trend line and has bounced back down when compared to the dollar. Discretionary also getting close to a golden cross here, but we're not there yet. Low volatility stocks, That was the place to be in 2022. We're seeing now a recent death cross, and they are really underperforming the S&P. Energy, which was really doing well in 2022 compared to tech, is now underperforming, and we're seeing a death cross with that ratio. Longer term, these apply for as long as they apply. This was generated last October when we potentially hit the low, and it stays on the books until it doesn't. I don't really have a good definition for that. And then another long-term one was generated back in March. This is the SWAG NYSE Brett Thrust, and this also stays on the books until it doesn't. Then this is another kind of interesting thing with the old Midwestern name of Zahorchak. And this is a longer term look at, are we positive or negative? Where we were negative for 2022 and 2023, we recently shot up to the top, which means we've switched over to a longer term positive stance. Our longer term momentum studies, going back and comparing what was it like in 1998 to 2004 and what was the MACD doing at that time. We were trying to break out above this trend line. That failed because look at what the MACD was doing. Then we tried it again. Breakout, fail. MACD was still below zero. We compare it to what happened in 2007 through 2010. Breakout, fail. MACD was sideways. What's going on now? Breakout, MACD's above zero and advancing. So that's looking a lot better. So what's the outlook then? This is the economic calendar for the upcoming week. The big one is going to be Tuesday with CPI. That's the measurement of inflation. Then we have another big thing happening on Wednesday with the PPI and the Fed coming out with their announcement. That will be at 2 p.m. Eastern time. Then on Thursday, we'll get retail sales. And then another one that I think is kind of important is industrial production and capacity utilization. Then we'll get consumer sentiment on Friday. We have one speech that'll be happening this week for the Fed. That'll be on Friday, the 16th. Governor Waller, and I'm sure you're going to all tune into this, he's going to Norway and he's going to be talking about the future of macroeconomic policy. Man, just feel the excitement from that. Then looking at the Stock Traders Almanac statistics for just Monday, June 12th, we're negative across the board with the Dow, S&P, and NASDAQ being up way less than half of the time. We will be on the 8th trading day of the month on Monday, where the green line, which is dashed, that looks a little more positive. That's a pre-election measurement, and we're actually up a little bit there. But when you look at tech and you look at the NASDAQ, you remember this is, sell in May and go away cliche. Well, I don't know how it rhymes with the NASDAQ. They tend to stay stronger going into the mid part of July before they sometimes turn weaker. All right, our scenarios, and this is just based on Monday's session. We're not going with the down one right now. We have to go with the up one because our daily ADX is now finally trending. We're also starting to turn up on the weekly chart, but we're still below 20, but we're looking more positive. But we have overhead resistance until we can close above the 4,300 level and even better, get above the August 2022 highs. And I know I've said that before, but that's the real big thing right now. It's really going to be hard for this market to really break to the upside. And we're not going with the sideways one for right now because we are trending. So our warning signs, this is based on the daily charts as of Friday. Inside the S&P 500, the new highs, new lows, they're not expanding as much as we would like, but they're hanging in there too. But we want to see them really breaking out. The BPI, it's above 50 and advancing, but it's still lagging behind what's happening. We have a lot of negative divergences. We have some weak areas that we've been following. These continue to show some improvement, especially if we see more follow-through buying with the small caps and the mid caps. The VIX is still showing a lot of complacency, not only on the weekly chart, but also on the daily chart. When we look at the NASDAQ, the cumulative new highs and new lows, even though the NASDAQ's been doing pretty good, the cumulative new highs and new lows have been going down. The 3-month yield, I didn't show that in this video. We're breaking above where we were at back in 2007, right before the great financial crisis. Is that telling us something, or is it trying to warn us about something? Small caps generated a recent death cross on the daily chart, but we've seen a lot of strength lately. Earnings season is still here that we're trying to deal with. On the positive side, the seasonality, that MACD chart that I looked at, some of the Stock Traders Almanac charts, the bigger picture things that we're looking at, those are still there. The NYSE breadth thrust charts, the Copic curve, and the Pring bottom fisher on the daily charts are generating a buy signal. The S&P is still above a downtrend channel on the upper line that had acted as resistance. We bounced down from that a couple of times. Well, we've been able to break through above that, and we're still above that. We're switching back to being more risk on now, favoring stocks over bonds. Lower price levels may provide support, which could also mean a moving average, a Fibonacci retracement, a level in a different index. That's why it's really hard to come up with a list of support and resistance every day, because it could be almost anything. The S&P is outperforming utilities, which often gives strength to the S&P. The NASDAQ and NASDAQ 100, they're still hanging in there pretty good. And staples to the S&P 500 ratio is declining, and that often gives a lot of support to the S&P. I have some warning signs that I talk about in the daily video. So if you're more interested in that, please check that video out. The mid caps are in the process of generating a golden cross after giving us a death cross not very long ago. Now they're switching back and looking more positive. And small and mid cap growth is still hanging in there when we compare it to value, but we have seen some weakness overall. Thank you. I hope you found this helpful and not too clumsy. I would love to hear some feedback about this. After this, I'll be preparing and posting the intermarket analysis video. The daily posted Okay, let me back that up. The daily video is already posted, so you're welcome to check that out. So I hope you're having a wonderful weekend, and I will talk to you in the next video.